So I did a video earlier this week entitled Dow 11,700. And my thesis was that within the next few years, we would probably see Dow 11,700. This is once again my opinion. And my reasoning is that we're in a secular bear market and patterns tend to repeat themselves over the past century, right? I showed a graph about that. And the last secular bear market we had was in 1965 to around 1981, where the Dow went nowhere if they bought and hold. And in my opinion, we are about to see that. When the margin debt starts to decrease, when we start to see some deleveraging going on, the carry trade unwinds, and all that stuff. And we're in the process, in my opinion, of seeing the carry trade unwind. And I noticed this one comment, and instead of typing in a long response, I decided to do a video. And it's by YouTube user Carib Surf King 1. QE is the one historical change for predictive models. Maybe QE is messing with your predictions. Okay. Once again, we don't know what the future is going to hold, and I'm still holding by my thesis that we're going to see the Dow plunge maybe 20-25% from where it is right now, or maybe a little more, close to around Dow 11,700 or Dow 12,000. Some other people are saying Dow 12,500. But now let's look at this. Alright, I see the Nikkei Stock Exchange here, and this is at the St. Louis Federal Reserve website. And I just put in a time frame of 2001, March 19th, 2001 to Friday, April 11th, 2014. I think it was Friday. Yeah, it was Friday. So here's the graph here. So 2001, 2014, as you can see here. And you may ask, why did I put the date 2001 or March 19, 2001? Well, the reason why I put that was this was the day, based on researching this, that Japan engaged in quantitative easing 1. Okay? So this is like around April-ish, right? Dow 13,934. Where's the Dow as of right now? 13,960. Okay? So this is when QE1 began. And during this time frame, we've seen ups and downs, obviously. And if you want to look at it, right, how many quantitative easings has Japan had for the past, I don't know, 10 some years, right? Are they on like QE9 or something like that? So let's go back to that comment. QE is the one historical change for predictive models. Maybe QE is messing with your predictions. Well, all I want to say about this is that when it comes to Japan or the United States, we haven't experienced the hardcore deflation of the 1930s. What we've seen is the market that has been choppy and sloppy. So we could look at Japan once again, and we could see that the market went nowhere despite all this quantitative easing. And then some people might say that, hey, guess what? Japan is a lot different than the United States, because Japan has an aging population, they have a homogenous based society, their immigration policy is a bit, not controversial, they're just xenophobic, you could say that, when it comes to immigration, right? And then the United States, on the other hand, some people will say, hey, it's a heterogeneous population, we allow immigration from all types of the world, or from all countries, and you could look at the example of Sergey Brin, Russian immigrant. When he came here when he was 6, his parents brought him over here, obviously. They were immigrants. And Sergey Brin is the CEO of one of the most innovative company out there, Google. So you could argue that America is a lot different than Japan. That is true. And long term, after 2016, 2017, I believe for like the 16, 17 year span, we're going to be in the best bull market of our lives. And I'm not joking about that. I truly mean that. But if you want to look at the short term, here are my concerns, and I could go over them again. if you remember the market sell-off last week, I mean, we could see Dow, I think it was close to 16,400 at one point earlier that week, if I remember correctly, and it's down to 16,000. If you look at the price of oil, right? Oil stayed flat, right? And why am I talking about oil? Well, if you start to see oil prices continue to rise, and in my opinion, why it didn't roll over is what is going on in Ukraine right now and the potential of civil war, as crazy as that sounds, and also with this petrodollar standard and all that stuff. When it comes to Obama, he may enact more sanctions upon Russia. So the oil speculators are holding the oil price higher than where maybe it should be. So that's really interesting right now. And if you want to look at some other inflation indicators, I could show you. So I'm on finwiz.com again, and I like going to this chart. And if you look at for the year, right, you could see some commodity prices that are doing fantastic. So, not fantastic, but like they're in a bull market. I mean, they were in a relative bear market, such as coffee. And coffee's up 81%. I mean, if you look at the ETF JO, it's like been on fire lately. I'm surprised it's gone up in a straight line like that. Lean hogs up 41%, orange juice, corn, oats, pork bellies, all up. Soybeans, coca, and wheat's up 9% as well. So, as you can see over here, we see these prices going up. And if you start to see prices going up, what's this ultimately going to do to the margins of these companies? It's going to bash them. When we see the margins get bashed, then what's that going to do for their EPS? It's going to hurt their EPS. And since all these companies bought these shares, remember, the shares outstanding. If you remember, EPS, earnings divided by shares outstanding. So if they start to miss on earnings because of margin pressure due to some stagflationary pressures that we're seeing right now, in my opinion, then the stock price is going to get pummeled. And since everyone's on margin debt, right, it's going to adversely affect the stock market. But since there's still the perception of Janet Yellen being a dove, I don't think this market's going to go down in a straight line. Just as Panama and Orange told me, he doesn't think it's going to go down in a straight line. He thinks it's going to be a choppy road and a 25 to 30% correction from the highs. This is what he's told me, I think, on air as well and off air. And we were talking about this the other day. Right now, oil prices at $103, right? I tried shorting oil, by the way. It must have been a month and a half ago. And I thought, like, hey, this is a good opportunity to short. But then the Ukraine situation came up, and I'm like, crap, I hope I get a chance to sell my short position. I got out of it. I broke even on that trade. But I'm glad I got out of it because right now oil's at $103. I mean, what I'm looking at, it still seems overbought, but you have to look at the geopolitical tension, right? And the potential of sanctions by Obama. And this is not even summertime, right? Just imagine summertime, the weather gets better. More people are getting these part-time jobs, right? And all that stuff, right? I've talked to recruiters, by the way, and they said that there are more jobs in accounting than they've been able to fill, right? Firms can't fill some of these jobs because they can't find qualified candidates. That's another story, by the way. But regardless of whatever you think on the economy, what we are seeing are higher prices. In my opinion, higher prices are going to lead to problems with their margins. And I want to show you one last thing. The last thing I want to show you is the PPI numbers for March. And this is from the Business Insider. PPI prices were hotter than expected. And once again, I don't like the Bureau of Labor statistics. I have issues with how they calculate the data, but let's just go through this quickly. The BLS just released its PPI report, and it looks like inflation is a little hotter than expected. PPI jumped by 5% in March, which was much higher than the 0.1% expected. Excluding food and energy, prices jumped 0.6% versus expectations for 0.2% gain. Over a year-over-year basis, prices climbed 1.4%. The expectation was for 1.1%. Here's a chart from the BLS for some historical context. So the PPI is showing higher inflation. Not that much right now compared to what they expected, but if these trends continue, I would expect margin pressure to get not killed, but it would affect it in a negative manner. I mean, if you look at, for instance, right, coffee went up 80%. Look at the price of Starbucks. It's corrected from the highs of, I think, like $82, right, to like $69, right? Once again, I don't expect these stocks to fall down in a straight line, but I do expect them to go down gradually. So this is what I expect. Could I be wrong with my models? Sure. I'm just saying this is my own thought process. I'm not going to guarantee anything, just number one, disclose that fact. So anyways, thanks for listening to me, guys. Talk to you later, and let me know what you think about this. Talk to you soon. Bye.